Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. So in this video, I'm going to focus on something that I think most traders don't pay enough attention to, and that is which day do you want to be a buyer or a seller? So if you want to be a buyer or seller, even if you're a swing trader, you want to catch these big trend days, right, to the upside. And if you want to be a seller, you don't want to be selling it down. So let's just take this week, for example. If you sold it down near the lows every time it started to look ugly, you've had to sit through a lot of chop. So if we look at the current market here, and let's be market neutral, all right? Let's not put any bias towards whether I should be bullish or bearish. If I look at this consolidation and say, I want to be on the right side of this breakout, or I want really low risk trades, don't you want to know which day is the right day to anticipate it's going to either break out to the upside or break down to the downside? And if you're a bull and you have a bullish bias thinking I'm going to follow the trend, wouldn't you prefer to be a buyer down here? And if you're a bear and you think that's it and it's rolling over, wouldn't you want to be a seller up here? I would think you would. And there are some pretty straightforward tactics that day traders know, because a day trader needs to know the direction of the market that day, right? Because they're going to get out at the end of the day. So in this video, I want to show you just one way that you can easily do this. Apply it to today was a really perfect example of how powerful it is. And before I do, I just want to make sure if you are watching this on YouTube, please subscribe to our channel. And also please know that you can find this video and a whole bunch of others at marketgauge.com/tutorials, and you can also find more information on Twitter if you follow us at MarketGauge or at MarketMinute. Now, also be sure to use the settings button in the lower right hand corner to see this in HD. All right, so I'm just going to focus on today for a second. So if you wanted to be bullish if you wanted to be bullish with the general market, you want to find the day where it's going to trend and really break out of this consolidation and move higher. That's the day you want to buy it, right? Or you want to try and buy it against these lows. Now, if you want to be bearish, if you have a bearish bias, then you probably want to be a seller against either the high of this consolidation or a seller against the high of this consolidation if you get the opportunity to. But what you don't want to do, regardless of which way your bias is you don't want to buy it up here if you're a bull and have it do what it did today, right? And if you're a bear, you don't want to sell it down here and then have it go right back up on you. That's the worst. So let's take a look at how today sets up. So let's take the position that I first wanted to be a bull. I want to know whether or not I should buy this breakout to the upside. All right. Now, if I want to be a bear, I want to be a seller as close to these highs as possible. All right. So now let's look at what happens intraday. I'm going to go to 5-minute charts, and I have on my 5-minute charts a focus of looking at where's the first 30 minutes of the trading day. We call this the opening range, right? First 30 minutes of the trading day. And what you want to see in the very basic situation is if you're a bull, you want the market to trade far enough above this opening range and then continue to move higher. And that can lead to a trend day, all right? So there's the 5-minute or the 30-minute opening range on the SPYs. There's the 30-minute on the Qs. And actually, wait, let me take one step back. If you're not already looking at a screen, the way I have it set up here, I would highly recommend that you do this. So I've got 4 major indexes here: the SPYs, the Qs, the diamonds, and the IWMs. Right? I look at how they're all acting relative to one another. It's incredibly powerful. Now, if you take the opening range, the first 30 minutes of the trading day, and you look at how these all trade relative to their opening range, it's even more powerful, and that's the key to this video. So The first thing that happened today was the markets broke out of their opening range. One bar didn't really follow through. Now the Qs, you can't really see it here, but the Qs were not able to get through that prior day high. All right, the SPYs did by just a little bit. IWMs did by just a little bit, and the Dow did by just a little bit. So the question is it going to be a trend day? Now, it looked like initially that it might be based on what I would call a novice interpretation of the opening range, where you've got a breakout above the opening range. But the problem is you didn't follow through, right? So when you don't follow through and you come back through it, that's not good. So from the bull's perspective, remember, if I wanted to be bullish and I'm looking for the right day to be a buyer, today was not, because we didn't get the follow through. Now, if I wanted to be a seller and sell against these highs, it might have been a little aggressive to just be selling when it fell back into, but that would be your first indication. It could be a seller as it rolls over. And there's one way that you wind up selling against the high. But the pattern that I really want you to walk away from this video with is a much more reliable pattern than just assuming that it rolls over. And we do have some patterns for rollovers, but that'll have to happen in a different video. So what I want to focus your attention on is that this is now the high of the day, right? So if you're looking to be bullish, you're not going to be bullish until it takes out that high, or look for a reversal near the low. Now, you got a reversal in the Qs, but what you didn't get is any kind of a reversal in IWM. So you want them all to be doing the same thing. Now, the next thing that happens is the Qs rally almost back up to their highs. SPYs don't do nearly as well. And IWMs never get back over their 30-minute opening range. So if you wanted to take the position of now you're a bear and you want to be short against a good stop, you've got a great stop against the high of the day with the Qs. And IWMs right here are telling you when they start to roll over that the chance of the Qs getting back over that high, not good. All right, so by using these four charts and the opening range, I didn't want to be a seller against the highs, but if you did, this was a opportunity as it begins to roll over and IWM begins to roll over. You know at that point that this market is not in any shape to go much higher, so the bulls are kind of out of it. And the bears can start to say, this could be a low-risk shot so that I could get short. Now, if you're a swing trader, wouldn't you rather be going home short down here, having gotten in here, rather than just waiting until the end of the day or waiting until it breaks down here to get short? This is a much better place. This is just one easy trick that you can use with the opening range, right? Now, with earnings seasons coming up, you want to focus on that first 30 minutes and that first 5 minutes. And that 5 minutes, or 5 minutes is often used for gaps. And I'll give you one more example of the power of being able to know when to get in and keep your stops tight. Now, last week I did a webinar on sector rotation. And in that webinar, sorry if you missed it, but this is a different topic. In that webinar, we talked about the fact that gold was one of our industry groups that was under accumulation and one of the sectors you wanted to be in. And also talked about the fact that one of the signals didn't really show up until right about here, and then it gapped higher. It was tough to get in. And I said, unless you really know how to trade gaps with low risk. And one of the things you can do with opening ranges is trade gaps with low risk. So I actually got into AEM on this gap higher day because I had the confidence of knowing where I was going to be able to get out, because by using opening range rules, much like the ones I just showed you, I was pretty sure with the low risk and the fact that this was one of the industries or sectors that's been really strong, that's a gap I want to follow. So why would you do it? Well, because in the right environment, if you're right, you can wind up seeing a swing trade that continues to move like this, all right, with a really low risk. So focus on that opening range, especially with these earnings announcements. It can tell you which breakouts to follow and which breakouts to fade. Incredibly important during earnings season. I think you'd agree. All right, but for right now, and to walk away from this video, make sure you're looking at the four basic indexes, for stocks, and their opening range, and you'll have a much better sense of which days are likely to have a reversal, which days are likely to break out and continue. Now, that's just one little trick. I'm going to go over a few more tricks just like that in a webinar this week, and I will put a link to that in the text of this blog post. I hope you can make it, and if not, I hope this, like all the trades and tutorials videos, has been very helpful, and I'll see you in the next video.